All right, we are going to have some fun today. We're going to take a look at a product that complies with the new 7702 change. We're going to look at MassMutual's whole life 10-pay product. So MassMutual raced to be the first to the marketplace with a product that complies with the new 7702 limits. So what we're going to do in this case study is really compare the old product directly with the new product. And what I mean when I say that is taking MassMutual's 10-pay product, comparing apples to apples. What are the differences specifically when designing a policy for maximum cash value? And we're going to go through everything. Really, I had a ton of questions going into this. So I want to make sure we answer all the questions I had and questions that come up as well. So to begin, if we look at MassMutual's old 10-pay product, which is still available through November of this year, we have a guaranteed cash value interest rate of 4%. The declared surplus rate for 2021 was 2%, which equates to a total dividend interest rate of 6%. That is with their present 10-pay product, the old product, based on the old MEC laws. The new 10-pay product, here's the difference. Firstly, this is only available through their Cover Path program, which is a program that utilizes a lot of artificial intelligence from an underwriting standpoint. They've come a long way and are continuously improving that program. But a disadvantage to that program right now is that MassMutual's LISR rider is not available. If you've seen any of our content specifically on MassMutual, the LISR rider is a great feature to add to a whole life insurance policy to provide maximum flexibility. If I've got that LISR component attached, I can easily adjust payments each year on my anniversary date without any underwriting, and I don't have to deal with the complex planned AILR and scheduled AILR, which is their standard PUA rider. I don't have to deal with those complex rules. So let's continue on here. So specifically looking at the guarantees, here's a big difference you'll likely notice right off the bat. You probably saw it already. The old product had a guaranteed rate of 4%. The new product has a guaranteed rate of 2%. Now, MassMutual still applies a total dividend interest rate of 6% to the policy. So what that means is that the declared surplus rate then for it would actually be 4%. So I still get that 6% no matter what, but we see a flip-flop there. So where that can hurt us is in the event that dividends come down, I have a lower guarantee. If they ever go below 4%, that's where it could potentially hurt, not just with MassMutual. This case studies with Mass because they were the first one to actually release the product, which says a lot. A lot of companies are kind of sitting on the sideline waiting for other people to come out first. But that's something we will see with all carriers. What I mean when I say that is if dividends come down below 4%, that's where we could see it hurt a little bit. But again, time will tell there. So in respect to MassMutual specifically here, all of their whole life policies will be released and updated in November. That's typically when they declare the next year's dividend interest rate as well. So likely what they'll do is say, here's our new dividend rate, and then here are all of our products with the new guaranteed rates, complying with the new MEC limits based on the 7702 limits. Now, what I also want to add here is different products will have different guaranteed interest rates. So companies have the option to choose a range to determine what the guaranteed rate will be for each product. For example, their 10-pay product has a guaranteed rate of 2%. Their Legacy 100 product will have a guaranteed rate of 3.75%. Also, other carriers will be releasing products in the near future. We've heard from one carrier, I should say, that products will be released over the summer, end of the third quarter at the latest, at least for their core products. As we have more information, we will be providing that as well. But this will provide additional insight really to new products, guaranteed cash values, non-guaranteed cash values, but really the MEC limits too. Here's this is going to be the interesting part of this case study, breaking down the MEC limits and seeing where they actually fall. Let's continue on here. So in this case study, here's what we looked at. A 40-year-old male, ultra preferred, old 10-pay product, $10,000 base premium, 10-year renewable term rider used to raise our MEC limit, and then approximately $88,000 towards scheduled AILR. Why I say approximately is we're looking at the old and the new product here. Now, I want to add something here in respect to MassMutual's renewable term rider, RTR, i.e. term rider, that is actually a level term rider for the first 10 years. Pardon my poor penmanship on the screen. So it is a level term rider for the first 10 years based on their current expenses, midpoint expenses. But if we were to look at the guarantees, MassMutual does have a provision with that term insurance rider to raise the cost of it, as it can still function as an annual renewable term rider. They can raise the expense of the term rider beginning the second year. And why that's important to note is in this case study, I didn't want to just look at the non-guaranteed values, because then we can easily make one product look better than the other. And you'll see what I mean as we get into it. But I wanted to look at the guaranteed values as well. And when we've got that term rider attached, we see that occur. Now, this is another reason I mentioned the LISR rider earlier, is that LISR rider that provides flexibility that we could keep a clean $100,000 payment on the policy as we look at the numbers here. No, this is technical stuff. I'm going to push forward. So MEC test, this is huge here. And what I'm going to mention is very, very important. So the MEC test was run based on the current dividend, midpoint dividend, and also the guaranteed values. I'm going to show you exactly what I mean here. In fact, let's pull that up and then we'll touch on the next bullet point. So when I say MEC test was run based on all of those assumptions, here's specifically what I mean. When we go down to the narrative summary, I do not just want to run an illustration and see that based on the current dividend rates, the policy did not MEC. That's where so many people, agents and clients, get into trouble in the industry because they see an illustration state that this policy will not MEC based on the present dividend rate. Dividends come down, then all of a sudden we can run into a MEC issue. So seeing this, not a MEC, based on the midpoint supplemental values, based on the guaranteed supplemental values, is very important. And this is a reason as well that we overinflated the MEC limit. So we're paying in $100,000 per year. You're going to see that in the design. We've got a MEC limit of 125. Based on the current values alone, we didn't need to go that high. However, if I want to cover myself and protect the client, which is most important, I definitely want to look at a conservative different dividend interest rate. This way, if dividends do come down, I don't have to come and be the bearer of bad news and say, hey, you're going to run into a MEC or you have to reduce your payments, which is a pain. No one wants to do that. So we made it a point to thoroughly stress test this, both the old and the new product as we went through everything. So again, there's a recap here. We did this to prevent a MEC surprise from occurring down the road. Funding periods we looked at here. 10 years, looking at the guaranteed values and non-guaranteed values. And what you'll notice here when we look at the guaranteed values is they do display a higher annual outlay. What I mean when I say higher is we've got a total of $100,000 per year paid to the policy for 10 years. And why it's higher is due to the term cost increasing beginning year 2, only based on the guarantees. Fun stuff, right? You got to love these complexities. So we did that with a 10-year funding scenario and also a 7-year funding scenario. Here's the main reason why, is we executed a reduced paid up in year 8 with both the old and the new product. A lot of people aren't aware of this. Mass Mutual's limited pay products have always carried a significant advantage when a reduced paid up option is exercised. So if I take a L10 or an L12 and go reduced paid up in year 8, you will see that thing hum in terms of non-guaranteed cash value performance. Very, very strong. You'll often see it out illustrate Penn Mutual policies as well. And then you get Penn Mutual agents that come in and say that's impossible. And then other agents say the same about them. That's another topic. But anyway, point is the numbers look good when we look at them. Okay. So the old product has always had a strong advantage. Really what I'm interested in here is, does the new product have that same advantage? Now we've got some notes here as well. What I want to sum it up with here is we used an optimal blend to minimize expenses, minimize compensation, which we always do, and maximize consumer value. And we looked at different splits to see the dividend treatment as well, but what we found is a 1090 design still optimized the cash, especially when we're looking at the guarantees. There was a world of difference there. The lower the base, the stronger the guarantees. So let's have some fun with this. What we've got, look at this illustration. Old 10 pay, old MEC loss. If we zip down, a lot of information here. There's the guaranteed values, midpoint values, current values. Okay. So here's what I want to look at if I'm paying money into a life insurance policy. Where is my money going as the consumer? Because when I pay $1 into a policy, I, the consumer, so if you're considering a policy, you can actually choose where your money goes. You can direct it toward the insurance premium portion, which we see right here. Here's the premium at $10,000. Scheduled AILR, that stands for Additional Life Insurance Rider. That's Mass Mutual's term for their pure PUA rider. And then we see a renewable term rider, which again, this is level based on the current expenses for the first 10 years, meaning it's going to stay level at that $3,300 per year. It can increase, but likely won't. Everything would have to go south for that to occur. But we did run that scenario as well. So what do we have here? 100K per year going in. Cash value right off the bat, about 87%. Death benefit, $3.4 million. Now this is a 10-year fund. MEC limit, $125,000, which is high. That's higher than we probably need when you really look at the MEC test and how it works. But at the same time, we didn't want to see a MEC even occur in the guarantees on either scenario. I wanted this to be apples to apples, which is why we overinflated it. So break-even point, just about year 5, positive year 6. Okay, let's take a look at the new product now. So here's the one thing to keep in mind. Old product, $3.46 million death benefit, gave you a MEC limit of 125. Let's do this. Old, 3.4 million equals $125,000 in terms of a MEC limit for an age 40 male. And I hate my handwriting on this thing. Use some artificial intelligence to improve it. $3.4 million, age 40. Pretty cool, huh? Let's go back to the study. There's the old product. Let's look at the new one. Same thing here. Let's scroll down. What do we notice here in our MEC test? Not a MEC, guaranteed. midpoint, supplemental values. This has to be a fair comparison. We use MassMutual. We use other carriers as well, but we want this to be a true comparison, not trying to skew the products in any way, shape, or form. So let's scroll down. Here we go. 100,000 per year. Cash value right off the bat, not 87%, 89%. Total death benefit, about 1.9 million. Before we look at the MEC limit, where's your money going? Policy design, premium. We've got it at 10%, which is as low as MassMutual will allow, 10% of the total payment. Here's your PUA, same thing with scheduled AILR, about 88K. And then here's your term rider, $1,800. So the term rider does not necessarily cost less here. The difference is we need less death benefit to obtain the same MEC limit. So we had a MEC limit of about 125,000 based on what? The $3.4 million death benefit. So when we look at the new, $1.9 million gives us what? Look at that. Very comparable. 130. What do you notice there? If you are interested in a policy for maximum cash value, if I'm paying in $100,000 per year, how are we often going to design a policy? If you say, hey, I want the ability to put in $100,000 per year, money can go where? Toward the premium or toward the PUA component. Dollars that go toward the premium do not credit toward cash value right off the bat. So we're going to set that premium as low as we can, which in this example is at $10,000, add a term rider, but really direct the rest toward PUAs, and we've got that 10/90 split. Now, that's the insurance company limit. What else do we need to be aware of? MEC limit. So with that MEC limit, if I want the ability to put in $100,000 per year, how high do I need to have the MEC limit? At $100,000. So based on the new MEC limits, or the new 7702 rules, we see a death benefit of significantly less, almost half, obtains a very similar MEC limit. So I need less life insurance, less death benefit to be able to pay in the same amount of money. So that does give me a slight advantage. Now the guarantees were cut as well, so that gives me a disadvantage, but it is good to be aware of that. And we'll have more content in the future that really goes into detail on that. So let's continue on here. So we've got the comparisons there. When's our break-even point? Just about year 4. You can see we're stronger year 5 in the new product in terms of cash value. We're stronger right out of the gates. Now, rather than flip back and forth here, these are the two 10-year funding scenarios. We've got the 7-year funding scenarios as well, but let's focus on the 10 years. So what we will begin with, we're going to have some fun here. We've got a side-by-side comparison looking at the average internal rates of return, the annualized internal rates of return. Let's see a direct comparison. On the left, we've got the old 10-pay product. What we did was just peel the numbers directly from the spreadsheets or the illustrations we just looked at. Old 10-pay, minimum premium, non-MEC. And you'll see everything matches up. 87, 423 right off the bat. There's our death benefit. That gives us the MEC limit of about 125, which annual internal rate of return, negative 12.58%, which is common for a traditional whole life insurance product. Average IRR in the first year will be exactly the same. Scroll your eyes to the right. New 10-pay product based off the 7702 laws. 100,000 going in. 89% right off the bat, a bit richer. The key culprit of that is a lower term rider in the first year. Lesser term expense, more money could go to PUAs. That's exactly what that was. There's your $1.9 million death benefit. A little bit stronger right off the bat, about $1,600. Okay, not bad, an extra $1,600. As I look at it year over year, what do I notice? Break-even point, stronger. Year 5, I've got 512,000 compared to 498. It's becoming a gap here. If I look at the annual internal rate of return, which isolates what my cash value grew by that particular year, what do I see here? 2.25%. That's net. So I've got a dividend rate of 6% here. The IRR represents the net growth after the company's insurance expenses, mortality charges. What did it actually grow by? And the average IRR is still negative here, 0.07%, because I have paid in a total of $500,000 and I've got about $499. So I'm still negative, less in cash value relative to what I've paid in. Compared to the new product, 2.89% on the IRR and positive on the average IRR. Now, what I also wanted to touch on here is the dividend column. Right off the bat, you notice a difference there. Now, why is that? Because the dividend rate is 6% with both of these examples. If we go back to our Word document that we started with, you may recall this. Old product has a guaranteed rate of 4% and a surplus rate of 2%, whereas the new product, guarantee of 2% and a surplus of 4%. When we take a dividend column on a life insurance illustration, that dividend column does not represent the company's advertised dividend rate, which makes it very confusing. What that dividend column represents is the surplus rate only. So to provide some more clarity here we've got the old 10-pay product. This dividend column, common sense would tell me, hey, MassMutual's dividend rate is 6%. So this dividend column should show a 6% rate. I mean, it says dividend. And this is not just MassMutual. All companies do this. That's not the case. What the dividend column represents here is a surplus rate. In this case, 2%, because we've got the old product with a guarantee of 4%. Compared to the new one, if I've got the same dividend rate of 6%, what does that dividend column represent? Guarantee of 2%. So a surplus of 4%. So when we go back to the Excel sheet, you do see a difference right off the bat. And look at the year 10 mark as well. Not quite double, but I mean, you're close. It's interesting how that works, isn't it? So if we look at the year 10 mark between the two, there is a difference based on the non-guarantees here, about a $36,000 difference. And if we stop here, or if we just continue to scroll down here, so it's a 10-pay product, paid up in 10 years. Let's look at age 65, 25, the year 25 value. If we stop here, we see a $130,000 difference. And this is where we hear the new product is much, much better. And again, we always talk about what? Actual performance, real data. I'm not a fan of looking at an illustration and saying, okay, this is the way to go all of a sudden. We need proof of performance. Now, we don't have any proof of the new 7702 update because this was literally released 2 days ago. but we do have proof of the major mutual companies delivering strong internal rates of return, all that fun stuff. But with that said, here's what I want to look at to take it a step further. So based on the dividends, non-guarantees, if I fund for 10 years, which one's stronger? Well, I don't want to go down to 121 years old. Let's go 50 years. There is a big difference there, close to $1.5 million. Same company, same dividend rate, just how it's priced differently. I see a difference in cash value. Even the death benefit, the new product eventually catches up. And these are max blended policies, high upfront cash value and strong long-term as well. Let's progress on to the guarantees. Because if I'm a consumer, I want to see this in middle of the road examples. So here, same product, but based on the guarantees. Let me go to the illustration first, just to validate what we're looking at here. Here we go. So remember that renewable term rider, if we go back to the Word document, 10-year renewable term rider. When looking at the guaranteed values, we will see a higher guaranteed renewable term rider premium. Well, it increases each year. And the reason why is based on the guarantees, meaning the company reserves the right to increase the cost of the term rider if they want to. The guaranteed values will display that. So with the old product, we have a larger term rider. So we see a higher out-of-pocket required. Really what we're doing is paying the same base premium and PUA each year, and then just covering the cost of the term out of pocket. You could let the policy pay for it, but again, we wanted to keep the out of pockets the same for the comparable cost of the term rider. The old one has a higher term rider, which is why we see a higher cost there. But what do you notice here based on the guarantees? 85, about 86% right off the bat. New product, lower term rider. So we see $582 more in the new product in year one. Year two, you see $200 more. From that point forward, what do you notice? Break even based on the old product, year 12. Based on the new product, year 15. Now we've paid in about 50 grand more to cover the cost of the term rider only. So that higher premium, because it's a term cost, is not going to boost the IRR in the old one. It doesn't work like that with term riders. If it was a higher base, it would, but the base premiums are identical at $10,000 a piece. What do we notice on the annualized IRR? Guarantees caps out at about 3.3%. You've got a gross guarantee of 4% here. New product, gross guarantee of 2%. What do you cap out at? After the funding, about 1.75%. Big difference. Here's one thing you can look at as well. Whenever looking at the guarantees, whatever your guaranteed death benefit is, if you're blending with PUAs after you're done funding, which is year 11, there's no dividends, purchasing more paid up additions. So the death benefit in the old product, 3.35. Doesn't ever increase because we're looking at the guarantees. The cash value will hit this number at age 100. New product, the same thing occurs. But what's the difference there? That is significant. So looking at this over time, if we go 25 years down the road, do we see a difference? Yeah, based on the guarantees, about $400,000. We've got an average internal rate of return of almost a clean 2% with the old product, whereas the new product, about 0.84%. And as time passes, you just see a similar trend here. This is the kind of stuff that actually took a long time to put together, just how the reporting is outlaid, but it's the kind of stuff we want to see up front. I do not want buyer's remorse if I'm looking to pay in $100,000 per year 10,000 per year, million per year, whatever it is. Like, I want it transparent so I can make an informed decision. And these are all 10-pay products. When we're designing policies for maximum cash value with maximum blends, 10-pays aren't always the most attractive when you really compare them to other products and you want more flexibility and such, but it's interesting. Okay, let's progress now on to the 7-year fund. So same policies here. Well, we made a tweak here because we're only funding for 7 years. We made an adjustment specifically in the MEC limit. So let's take a look at the old 10-pay based on the current values. Old 10-pay product, $10,000 base premium, PUA rider, renewable term rider. There we go. Same thing with the term. Total death benefit, about $2.9 million. Where we came up with that? Look at this, MEC limit, slightly overinflated, 105. And we did that. We don't have to because it's a 7-pay. We did that because of the stupid renewable term rider where it increases based on the guarantees. That's considered premium, so it can trigger a MEC. So we had to overinflate it a little bit just to validate the same stress test when we looked at the MEC status based on guaranteed values and midpoint values. Got to do your stuff. This way a client doesn't get into trouble down the road, and then they're not going to blame the company. They're going to blame you if you're the agent. So here we go. $100,000 per year for 7 years. Total cash value. This is the old product. Keep in mind, about 88% right off the bat. Positive by year 5. If we look at the guarantees, there you go again with that increase, but we've got our MEC limit at 105. Everything's the same here. Let's go back to the current. Let's take a look at the new product. And here we go. $10,000 base premium. PUA, $88,000 and change. Term rider, $1,400. What was the death benefit on the old one? About 2.9. The new one, 1.5. What's that do for you in terms of a MEC limit? Almost the same, 105. We're at 106 here. Almost identical with the two. Cash value, instead of positive year 5, you're just about there year 4. And then we went reduced paid up. This one's going to be fun. We can look at the guarantees quick too, just so you can see everything matches up. Let's have some fun here. 7-year fund, old product on the left, $100,000 per year for 7 years. Crossover point, year 5, 88% year 1, minimum commission, maximum cash value, the works. Not quite the works because we can't use Lister, but you know what I mean. Annual IRR, about -12. Compared to the new one, you've got about $1,400 less in year 1. New 10-pay product, 100K in, 89% right off the bat. There's the $1,400 more. When's your break even? Just about year 4, which looks good. Year 7, reduced paid up. Now, earlier, we mentioned that MassMutual's limited pay products have had a record of producing strong long-term cash values, limited pay products, when a reduced paid up is exercised. And does the new one carry the same features or same advantage? So here you go, reduced paid up. Here's the IRR, annualized over time. Looks good. Here's your average. And we have this in the MassMutual illustration. If we ever look at it and say, hey, how does this work? MassMutual's dividend rate is 6%. How on earth do they have an internal rate of return above that? What you can do is, if you're a Mass agent, you can definitely subscribe to our ILS Agent Academy. That'll certainly help you out as far as designing policies and giving you a lot of insight of what we have. That's our agent training business. But 2, what you could also do is run the cash value increase ROR, the rate of return section, and that'll give you these same numbers right here as well. And these are the internal rate of return figures that we pulled directly from the illustration. So there we go. As a result of the reduced paid up, we see the old one just start to put rocket boosters on. And as a result, if we look at the year 25 mark, this is the non-guaranteed values. What do you notice? $273,000 more in the old product compared to the new product based on the non-guaranteed values. Extremely interesting. With the 10-year fund, what did we have? On the 10-year fund, the non-guaranteed values, the winner was the new product. The guaranteed values, the old one was the winner. With the 7-year fund, so if we're looking at a reduced paid up option, dividend values, new one's the winner. Let's look at the guaranteed values. So what do we see here? We've got the total outlay here because of that increased term rider expense, breaking even between years 9 and 10. Okay. New product, breaking even, year 12. If dividends are not paid, a product with a guaranteed rate of 2% has a disadvantage here comparing to the old one, which is strong when you execute a reduced paid up. There we go. With the annualized IRR, you don't get that same enhancement or that same boost when you look at the guarantees. It's strictly non-guaranteed, which says a lot. Average IRR, that's no longer in the red once you break even. What do you notice though in the cash value difference? Old one stronger, go to the same age 65 mark. $324,000 more. Now, what I'll add to this is one company with one product. I like among MassMutual products, their Legacy 100, as you have the ability to pay into a policy for a long period of time, can make it very flexible, and can have very strong guaranteed cash values and non-guaranteed cash values when you design it properly. So we typically use that, or most clients will lean toward it when they see an apples to apples design from a maximum cash value standpoint. And you can use Lisser with both, but right now we only have the old L100 available where we could use Lisser. But as new products come out, we will see differences here. So why I say that is I don't want to be quick to jump to conclusions when we see one example with one company. When Guardian, for example, starts releasing products, I do want to see theirs, because when the 2017 mortality table update occurred, I saw huge differences between carriers in respect to guaranteed values. With Guardian, I didn't see much of a change. There was a change with the MEC limits, but looking at the guarantees, they actually got a bit stronger with Guardian. Now, the rate was still 4%, so when that adjusts, we'll see where everything falls. But again, looking at different companies, products and such, as we have more information, that'll be very valuable in that respect. But hope that you enjoyed this. There's definitely more to come. So you may have some thoughts or comments or saying, Steve, you may have missed this. Always appreciate any feedback and insight. We already have included a lot more in our Agent Academy if you're in the business. If you're a consumer looking at a potential policy and you'd like more information, feel free to reach out to us anytime. We love building policies for individuals. We're definitely a bunch of insurance nerds here, but we're very big on customer service as well. But again, hope this helps. Reach out if you have any questions at all, and we'll talk to you soon. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.